There is a very specific dream sold to modern investors, the promise of passive income. The idea is simple. Buy some dividend stocks, sit back, and checks roll in. You get paid real cash, just for owning a piece of the company. But relying on those automatic checks creates a severe mathematical friction. While the money feels free, this strategy actively drags down your timeline to reaching actual wealth. The problem lies in what we call the tax drag. Every time a company issues a dividend, the government treats it as income. If you are in a higher earning bracket, up to 30% of that payout is instantly sliced off by taxes before it ever reaches your checking account. Taking an immediate taxable cash payout guarantees that a large portion of your money goes to the government instead of back into the market, restricting the long-term compounding power of your capital. That tax drain is bad enough, but investors chasing cash flow often stumble into an even more destructive pitfall, the 8 to 10% dividend yield. This chart shows exactly how that trap is baited. A dividend yield is simply the annual payout divided by the current share price. A high yield is rarely a bargain. It is usually a mathematical distress signal. If a company is in trouble and its share price plummets, the yield percentage spikes. Investors celebrate the small cash payouts they receive, but looking at the total value, they are actually getting their shrinking capital paid back in tiny increments. Buying a stock for the dividend without evaluating the actual health of the underlying business leads to the destruction of your principal wealth while you pay taxes for the privilege. There is an alternative to this continuous tax leak. It requires investing in growth stocks, companies that pay zero dividends and instead rely on internal reinvestment. To see the difference, we can compare the life cycle of an invested dollar on this split screen. On the dividend side, your dollar generates cash, leaks out through the tax filter we saw earlier, and only a fraction makes it back into your investment pool. On the growth side, the company takes that exact same profit and loops it right back into their own research, development, and expansion. The entire dollar remains inside the corporate boundary, shielded from your personal income taxes. This mechanism is called tax deferral. By keeping the money inside the company, you delay the tax event entirely. 100% of the capital is left to compound, uninterrupted, for decades. You avoid the forced fee of a dividend. Instead, you are effectively hiring the best CEOs in the world to manage and grow your money at maximum efficiency. To understand how this builds wealth, you have to stop evaluating stocks based on the cash flow they produce today and look at a metric called total return. This balance scale shows how total return is calculated. It accounts for the cash dividends a company pays out, plus the actual growth of the share price to show the true wealth generated. Because growth stocks reinvest everything internally, their total return is driven almost entirely by the share price climbing. Without a constant payout leaking capital out of the system, your portfolio gathers mass exponentially over time, operating like a compounding snowball rolling down a very long hill. The psychological hurdle here is that you don't see any immediate cash hitting your bank account. You have to be comfortable watching a number on a screen, while your actual net worth grows aggressively in the background. Total return strips away the illusion of free cash. It is the only mathematically accurate way to measure true, uninterrupted wealth creation over a multi-decade timeline. At this point, the obvious question is, if you only hold growth stocks that never pay you a dime, how do you actually extract cash to live on when you retire? You create what is known as a lifestyle dividend. Look at this expanding sphere as your total invested capital. Instead of waiting for a corporate board to authorize a payout, you manually sell off a tiny, controlled percentage of your portfolio, usually around 3%, every year. The tax advantage here is significant. Because you held these shares for years, selling them triggers the long-term capital gains tax. This is a special, lower tax rate designed to reward investment, taking a much smaller cut of your money than the ordinary income tax applied to standard dividends. You eliminate the automatic tax drag. You decide exactly how much money is generated, and you dictate exactly when the taxable event happens. You safely extract the exact living expenses you need for the year, while the massive underlying principal of your portfolio continues to compound untouched. Relying on a traditional dividend strategy makes you a passive dependent. You are at the mercy of a corporate board's payout schedule and whatever tax bracket you happen to fall into that year. Mastering the growth and sell-off strategy shifts that power dynamic entirely. It transforms you into the active CEO of your own net worth. Don't chase the dividend check. Chase total return, leverage tax deferral, and build a self-sustaining mountain of assets. Autonomous control over how your wealth compounds offers a level of financial security that a fixed corporate payout simply cannot match.